After 1974, the rules of retirement changed, and suddenly it forced E's and S's into the I quadrant with no financial education, and they started to put their money into these retirement plans. And suddenly, voila, a whole new industry was born called financial planners. Most financial experts will say, invest for the long term in a well-diversified portfolio of stocks, bonds, and mutual funds and ETFs. That's horrible advice. Today, it takes 30 days to become a financial planner. It still takes a year and a half to become a massage therapist. What do you think of mutual funds?
I think they're a great way to make money if you sell them to other people.
Investing for the long term in a well-diversified stocks, bonds, mutual funds, ETF worked as long as the markets were going up. If the markets are going down, it's going to wipe you out.
I think it's one of the worst places a person can put money. They really do. They make other people rich.
Following that advice, investing for the long term in stocks, bonds, mutual funds, and ETFs doesn't make you rich. It makes the guy selling you stocks, bonds, mutual funds, and ETFs rich. That's the difference. Okay, so let me ask you this. If I say to you, invest for the long term, for 30, 40 years, what do you think about that in a paper asset?
You've lost control that quick. Liquidity is what paper assets are about. Your ability to sell and buy without negotiation problems. And so the moment you say, I'm going to buy this, what control do you have? In real estate, you can force the appreciation, paint it, carpet. We can't do that with paper. Well, your only control is to sell. If you hold it forever, you're rolling the dice and saying, I hope it works out.
I want to take a moment to discuss mutual funds. Mutual funds are the most popular of all investment vehicles in history. I'm often asked, why don't I recommend them? And I'd like to explain that right now. Mutual funds are designed primarily for people who have this type of education. As I said earlier, there's 3 basic types of education which are required for financial success in the real world. That's academic, professional, and financial. Our school system has very little financial or investor education. So my poor dad, was the man who always said, this is very important education. My rich dad said this was important education. So to answer the question on mutual funds, this is the way it goes. If you have only this type of education, academic and professional, then mutual funds are perfect for you. That's who they were designed for. If you want to invest in other investment vehicles, then in most cases it will require more financial education. And it's not financial education you can learn in a classroom. It is financial education that is mental, technically, emotional, as well as physical. You have to do something. So mutual funds are great for these people, but I personally would not invest in them or bet my financial future or my retirement on a mutual fund. And the reason for that is this. As we have all found out just recently, but most of us known for years, what a professional investor needs to know, any market has 3 basic trends: an uptrend, downtrend, and a sideways trend. This is called a bull, this is called a bear, this is called a channel market. Mutual funds in most cases do well in a bull market, and they take a hammering in a bear market. So that's why I don't like them. The mutual funds I know lost so rapidly in the crash after March of 2000. The problem with mutual funds, they give you no personal control over your financial future. The market goes up, you do well. Market comes down, you lose in the channeling market. So that's why I don't like mutual funds. They give you no control.
That's right. And what makes it worse is that you take those paper assets that you don't have control over because you invest in the long term, and then you put them into a 401k, so you have even less control, because once they're in that 401k, you can't take them out. You really can't do anything with them.
You're penalized for early withdrawal.
You're penalized for pulling them out. And then on top of that, you don't even get the one tax benefit you get with paper assets is capital gains. And you put it into a 401k, you've lost that benefit.
Right. There's a lot of people say, stocks are the best way to go and don't get into real estate, a lot of these financial advisors. But the stocks are good for people who are not business people. You see, as entrepreneurs and real estate people, when you look at a financial statement, I personally am responsible for income, expenses, assets, liabilities. But as an investor, even in Microsoft, I have no control over income, expense, assets, and liabilities. Is that
All you
correct?
can do is sell or hedge. That's all you can do.
On top of that, when you pull it out, there's three types of taxes: earned income, portfolio income, and capital gains or passive income. And savings and mutual funds, what are they taxed at?
Well, when you pull them out, when it's going through a 401k, they're all taxed at that highest ordinary income rate.
See, in 1974, the rules of retirement changed. Prior to 1974, most people, like my parents, had a defined benefit pension plan. What that meant was that they received a paycheck for life. After 1974, the entire world started shifting onto defined contribution pension plan. What you put in is all you get back. And that's why these defined contribution plans, so many people are terrified of running out of money in retirement, simply because with a defined contribution plan, you can lose everything in the market crash, or you can run out of money before you die.
I'll tell you where I think the risk is. When you sit down and they say, we're going to diversify you. You know, that way if one company goes down, you got all these other companies to buoy you up. And that's fine for a non-systematic type thing, but a system-wide problem, it does not protect us if the system breaks down.
Because it's not diversification.
Yeah, it's more fragile now than I think it ever has before. And I think these people saying, well, I'm well diversified. They're not well diversified. You diversify across asset classes, not just in bunches of stocks, in my opinion anyway.
So the problem here with diversification doesn't protect you from a crash.
Right.
And it's not diversification anyway. And Buffett does not, Warren Buffett, the world's greatest investor, reportedly, says diversification is something like protection from ignorance. But it's ignorance from both the person selling you the plan as well as you who invest in the plan. But this is the biggest thing that really bugs me. When Kenny and I buy real estate, we always buy insurance, don't we?
Yeah.
And then when we drive a car, we have insurance, right? Is there insurance for mutual funds? Is there insurance on your 401k that what you put in will be there when you retire?
And which is more likely to burn down in the next 5 years, your home or your 401k?
And I'll say it again, we all drive cars with insurance, hopefully. We have houses with insurance. When we buy real estate, we have insurance. Our companies have insurance. But the 401k, all these retirement plans, there's no insurance on it. So if it crashes, they lose everything. And the mutual fund companies walk away with the money.
And that's a higher level of education because most people don't know how to hedge that. If you poll the average person, you say, tell me the difference. This is a very basic question. What is the difference between a defined benefit pension plan and a contribution plan? Most of the people I talk to do not know that difference. And that is not a minor thing. That is a major deal.